What's going on, gang? It's your boy Chike Investing here with another YouTube video. This is actually my first YouTube video I've taken where it's going to be actual educational content in about 3 years, and I'm going to be coming back with some fire teaching a model that has been true to my heart. I've been studying this for about 15 months now. I've executed on over maybe 500 plus trades. And have logged every single one and have understood exactly what are the ramifications. What is the best time to purchase, or when is the best time to enter in this model? When is the model likely to fail? When is it most likely to succeed? Right? Where should you put your stop loss, your take profit? Optimizing this model and refining it, and I'm now finally ready to share it with you guys today. All right, comment below if you have an understanding of what this model is going to be. Comment below if you already see it in the title; it's probably there. But this is the best strategy. The best strategy, at least for me, in terms of what I have seen work out there. But that may not necessarily be the same case for you, right? Models can be different for everyone, but based off my persona and based off of how I like to trade, this has been one of the most consistent strategies that I've seen working in the marketplace. That is very easy to the eye and very easy to see. Now, before I even continue, please press that like button. Press that like button if you I don't even know. Just press that like button, please. Just press it. Just press it. It supports me, right? I'm doing this for free. I only got 2,000 subscribers. I'm not really getting paid off of this, but I like talking about it. It also helps me to learn. So, as I'm doing this, I'm also reinforcing these things in my head as well. But I am spending time and energy out of my day to edit these videos, put the hashtags on them, do the SEO and everything. So, and I'm doing it all on my own. So, the least that you could do is press that like button. Leave a comment down below for what you got, what you're looking to learn. What are some areas that you don't understand that you'd like for me to teach you? And that's about that. But yeah, let's get into it. What am I going to be teaching today? I'm going to be teaching the 22 model. Now, the 22 model is something that was coined by ICT. He first introduced it in the ICT 2022 mentorship. Even prior to watching this video, I would really make sure that or you can watch it after this video actually as well. It doesn't really matter. This could be your first introduction. But then I would go and watch the ICT 2022 mentorship. If you don't watch that mentorship, you're going to be missing out on a lot of context of what I'm teaching today. So this can be a great starting point, but I would really recommend going and watching the full ICT 2022 mentorship. It'll really expand on what I'm teaching today, but today is going to be a very refined version of this model so that you can actually start going ahead and seeing it in your trading every day, right away as you're watching the mentorship as well. And so without further ado, let's get started. What is the 22 model and how does it work? All right, so before we even get into the trading strategy for the entry model, a lot of people make the mistake of, I want to learn what the entry technique is first. I want to learn the entry technique, and every time I see it, I'm going to buy it or sell it every single time I see it. And that is exactly why a lot of people lose, right? No entry model that you have that you see recurring over every single day actually is wrong or bad. It may work consistently. However, it's like choosing a strawberry. Let's say you're in a strawberry field and there is a bunch of rotten strawberries. There's strawberries who aren't ripe yet, and there's strawberries who are very sweet, red, bright, and green, right? Green stem, bright red. The seeds are, everything is good, right? You want to pick the strawberries that look the best and the most ripe for picking, right? Not every 22 model, not every time you see your entry technique show up, is it the optimal one for you to choose. And that is what determines a profitable trader from one who is not. A lot of times you look at your entry model, you're like, oh yeah, I see it. It happens every single day, but every single time I take it, or how come I'm seeing them, but I'm not being profitable? This thing just doesn't work. That's not true. It just means that you're choosing the wrong ones. So what I want to go over first, before we actually look at what the 22 model is to understand what is the context behind actually choosing a 22 model. What is the context behind, even choosing any entry technique? Now, the most key thing for this model that's going to determine your profitability is determining your bias, right? Determining your bias, right? You need to understand where is price going before you even think about executing on a trade. If you don't understand where price is going, you are going to just be a fish that the sharks are going to continue to just sweep your liquidity, right? The sharks are just going to continue to eat you up every single time. You're going to be the orders that people are attacking on the other side of the marketplace because you have no idea where price is going, right? That's why you keep taking so many losses. Every time you take a loss, somebody else is on the other side winning, eating up your profit, right? And so in order to avoid that, in order to avoid so much loss, you need to understand, where is price going? And what does that mean, right? That's determining your bias. And the next question is, how do I determine my bias? How do I develop a likelihood or a confidence that price is probably going to go in this direction? Well, I think the first thing is understanding, what is the likely draw on liquidity? So what does draw on liquidity mean? Well, first of all, let's define what liquidity is. Liquidity, right, is where orders are sitting, right? Where are orders? Where are the orders at? Or, we're going back into an inefficiency, right? We'll go a little bit about what those two things are as we go into this model. But let's start for a second here. In order for you to understand truly what liquidity is, think about it from this perspective. Who is running this particular price, right? People say, okay, well, price is determined by when a buyer and a seller meet at equilibrium, and when a buyer is decided to purchase at this price and the seller is willing to sell at that price, that is what determines the price. Well, in a normal market, let's say, for example, that there was no technology involved, that would be the case. However, there is technology involved. And it would be remiss for you to not think that there is something at the center of this who actually has a little bit more control than just buyers and sellers. If you look at price every single day and see the way that it moves and see with a certain level of predictability, price is going to go in a certain direction every single day, right? Or you can see certain patterns forming itself over and over again, right? That would be a sign or a signature to you that this is not just completely random. It's not just based off buyers and sellers, right? Price is not going to just completely go in the other direction at the most finite price point handle every single day just because all buyers decided at once I'm going to converge at this level, right? People have differing opinions. If price was truly randomized, price should just go up and down like this. It should just go up and down like that, right? Because buyers and sellers are always on the opposite sides of each other on the marketplace, unless there's a super, super large catalyst, right, for price to just continue to go up, right? So price is set by these exchanges, right? It's set by an algorithm, right, that is continuously on Wall Street that is basically booking prices to where they think the most orders are going to be. How does that make sense? So trading volume is largely dictated by algorithms that are buying and selling, right, as market makers. And that's why you see a lot of equity floors right now in banks are a lot more smaller than you think. Right, they're a lot smaller than you think. And that's because a lot of people have left because there's a lot of automation going on in terms of making markets. What do I mean by making markets? Basically, at these banks, they have a reserve of these stocks, right? Or let's just call it the NASDAQ exchange. They have a reserve of these shares, and similar to how I guess a merchant operates, right? They say, okay, I'll buy some more shares at this level, or I'll sell shares at this level, and it's their job to maintain however many shares they have, 100 millions or a couple of hundreds of millions of shares, right? So that when a certain buyer says, hey, Citigroup, I want to buy NASDAQ exchange shares at this level from you, or hey, can I sell some shares for you at this level? They are there to be on the other side of the marketplace, right? So these exchanges are the center warehouses of where price is being determined, right? To make it very simple, they determine exactly what price, right? Since they hold all the shares and they are facilitating the exchange between buyers and sellers, they are facilitating what price exactly at this moment would they like to keep, price at, right? To encourage sellers and buyers to start transacting, right? If I wake up in the morning and I say I have 10 apples, right? And I say, hey, I'm going to buy an apples at $9, and if I'm going to sell it, if you want to buy apples on the other side, I'm going to sell it to you for $11, right? So if people are coming in the morning and saying, oh, well, I'm only willing to sell you apples at $8, and then people are willing to buy apples at $10, then you're going to actually lower, you as the person in the middle, in order to facilitate transactions, right? In order for you to be making profit, right? Buying at 8, selling at 10, you need to move price to where the demand is at, right? And so that is why you see that is the very important context behind understanding why price is gravitating towards certain levels, because price is going to gravitate towards certain levels where transactions are most likely to occur. Now, in this particular instance, why would transactions be most likely to occur in this particular level, right? So at a certain level. So that's where we start to talk about liquidity. Liquidity is where you're going to see orders are mostly sitting at, and that's where transactions are most likely going to take place. And it's important for price to be moving to these levels because that's where buyers and sellers are going to be active, and then these exchanges can make money off of that bid ask, off of that spread, right? And so what does that mean even further? Let's look at how liquidity is engineered. How do you even see liquidity? What does that mean? Like where are orders most likely going to be? They're going to be over relatively equal highs, right, and lows, relatively equal lows. Like you're seeing right here, relatively equal lows over here, right? Relatively equal highs here. At these areas is where, retail people have been taught that, okay, price is most likely going to bounce up and down from here. So let's say, for example, this is what retail people would look at as like a resistance level, right? So when price gets back up here, right, they think they should go short. So people who shorted up here, they're in some money right now. However, all their stop losses, right? So if they had a sell limit up here, then their sell stop is somewhere maybe above here, right? And so price is most likely going to return back up to this level and trigger those sell stops at some point, right? Because if price is really going to sell off, they need a bunch of people to be on the opposite side of that, right? They need a bunch of people to be on the opposite side of that because in any market, there has to be a buyer and a seller, right? And if large pools of money, they need to move price, they want to make money, they need to be able to purchase a large amount of shares, or they need to be able to sell a large amount of shares from other people on the other side. And if they can encourage a bunch of people to say, hey, let me put my sell stop over here. What happens when price, and if price really wants to go down, right? What do they need to do? They need to go up here and take out these sell stops, because when those sell stops are triggered, that's saying, hey, a bunch of retail people are going to say, hey, I want to buy back all these shares that I shorted. And that is now buying back all those shares from large institutional money, right? Or smart money, as we would call it, where those people who can now, like people who now have those large pools of money can now sell it, right, to those people who are buying, and then actually allow price to tank, right? Because then smart money will start to make money. So can you see that based on my example, there's a bunch of orders up here and buyers or sellers are going to start interacting around this level, right? So that's why you want to know where is price most likely going to gravitate to, right? So understanding where is your draw on liquidity, understanding what is your bias, right? And how do we determine this? You determine this by going through from first understand where are the relatively equal highs, right? Let's spell that out. And equal lows. Where are those? Understand where are the inefficiencies, gaps, imbalances, right? If you don't know what a fair value gap, right? Fair value gap, volume imbalance. If you don't know what these are, then you need to go search that up. Go search ICT. It talks about these a lot, right? These are large gaps, right? So let's look at here, for example. This would be a gap, right? Right here, between this candle and that candle, right? Let's look at that even further, right? Between this gap and between here, that's a gap, right? You can draw a particular P array right there. That is a gap right there, right? This candle's high versus this candle's low. There is no wicks in between that, just bodies, right? So this is called a fair value gap. And you can see price is only coming in the upper half of this and then starting to move away, right? Price is drawn to this fair value gap. When you see it come back here, it is drawn into this inefficiency, right? So that could be one example of a draw on liquidity, right? Look at relatively equal highs up here. These are relatively equal highs right here, right? All the orders below here have been swept, right? All the orders have been swept here. What's left? A lot of relatively equal highs, good liquidity, big gap up here, relatively equal highs up here, final, and relatively equal highs compared to this high and this high right here. Do you see that? And so price is drawn to those levels. Understanding where is your bias? Price is drawn to those levels. Okay. Now that we understand that, you need to also make sure that you're going from higher time frame to lower time frame. What is one thing that I used to teach, right? What is one thing that I used to teach a lot on this channel for those who have been here for a while? Put it in the comments, right? I'm going to give you guys a second. Put it in the comments what you think. Pause the video, right? All right. Higher time frames trump lower time frames, right? Higher time frames trump lower time frames. Okay, so what does that mean? That means when you are determining bias, you need to be looking for these relatively equal highs and lows and these inefficiencies as you're going through each time frame, starting from the weekly all the way down to the 1 minute. You go from the weekly, the daily, the 4 hour, the 1 hour, 15 minute, 5 minute, 1 minute. Go through each of these time frames and understand where the relative equal highs, where the relative equal lows, where the inefficiencies, and where is price most likely to draw to? Where are we likely to draw to? Okay, all right. Another thing is that, your drawing liquidity could also be equilibrium, all right? It could be equilibrium. If price is at a heavy discount, right? What does discount mean? Drawing from this high to this low. If price is below this 50% line, it is inefficient to just continue to keep going and not at some point draw back up to fair value, 50%, right? Above the equilibrium. And so when you're on higher time frames and you see we're in a deep discount, your drawn liquidity can also be this 50% line, equilibrium line, because price needs to reprice there, right? And you'll see that in your own observations as you continue to log every single day and you continue to watch price. You'll see what I'm saying, okay? And also understanding market structure, that's very important, right? Are we making are the PD arrays below us, right? The PD arrays below us, for example, in this fair value gap right here, are they supporting price, right? If they're continuously supporting price, you can see this breaker right here is supporting price when it returns back down to it, right? We're continuing to see bullish order flow. When you're seeing order flow that is in a certain direction, right? You can see here that every premium array here is being respected. Look at this fair value gap respecting here. Price trades back up to it here and it respects it. All right, look a little closer. Price trades up into this fair value gap right here. All right. You can see price just trades up into that fair value gap right there. It respects it, right? And then it reverses. Okay, so it's very important to understand where you're at. And you can see as price continues to go down, there's more bearish order flow, right? We come back up here. Yes, we trade a little high, but we're just coming back into this rejection block from right here. We took out this candlestick's high right there, right? We're just returning to there. Then we reverse, trade through this volume imbalance, and then we come down, we wick, but then we reverse back up. We touch this order block right here. We move back down, right? Look at this wick. Study that. Price is trading right through the C of that wick and drops, right? We're clearly in order flow that is bearish, right? This is clearly a bearish order flow, right? Because we are respecting premium arrays as they're forming. Right here, we're respecting discount arrays as they're forming, as you can see, right? This discount array is a array that is below where you're currently at, right? So if price is right here, there's an array right here, which is this fair value gap. Price is repricing to that, and then it is reversing and continuing to go higher and higher. So what is the order flow? So order flow as well is really important to understand. All these things will go into you determining your bias. Understand where price is really likely to go. Okay, now that you understand where your bias is, right? Now that you understand what your bias is, we can start to focus now on what the actual entry is. Because once you have your bias, when you enter, you know that the probabilities are already on your side. You know the probabilities are already on your favor that price is more than likely to go here anyway. So that makes my entry much more likely to actually work out. So what do we look at next? We actually look at the execution. So the execution would involve, first of all, time of day and entry model. Now, why do I say time of day first? Time of day is also something that once you understand your bias or you know where price is going to go, it doesn't matter how good that 22 model looks. If it's not the right time of day, as ICT would say, it is not going to work, right? So what are some times that we don't trade, right? We don't trade like 6 o'clock, right? 6 o'clock up to 8 o'clock until Asian starts, right? You don't start that. If you want to know the times of day to trade, right? Research ICT, and the times of day to trade, I'll do another video on this. I won't go too deep into this right now, but just to know some sweet spots where I see like a lot of 22 models very forming. I particularly like to trade, during New York standard hours, right? So, anywhere from 7 to 10 a.m., right? 10 to 12 p.m. and then, 1:30 to 4, right? And then some sweet spots in particular, right? that I actually trade the most is from 10 to 11, right? 1:30 to 4 o'clock. These are the two sweet spots that I really like to trade. I'm in the market and looking actively in between these times, right? And I'll do a more in-depth video later on this. We can even get a little bit more defined. Macros are a really great time to see when price is actually most likely going to be in your favor. And so what are macros? Macros are 20-minute intervals typically, right? At the end of the beginning of each hour, where price is most likely to go for liquidity, right? And so that looks like 10:50 to 11:10, right? 9:50 to 10:10, 11:50 to 12:10, 1:50, 2:10, 2:50, 3:10, 3:50 to 4:10. All right. I typically never take any executions after 350. Yes, price may spike sometimes, but it's typically very short-lived, and you can't really catch a good trade during that time unless there's like some sort of big earnings report coming out. It's very hard to predict that. I don't like to stay on top of that. So typically within these time frames right here are where some of my most profitable executions can actually occur. Really up to here. I would say really this is where some of my most profitable executions can occur. There's also a macro for you guys to know as well. There's a macro that happens between 3:15 and 3:45 as well. So especially if you've seen price kind of like range throughout the day or it's gone up, you could typically see price around 3:15, maybe take out a high and then reverse into the daily range. Or if we've not been moving a lot, in the PM session, and wait for that time around 3:15, 3:45 for price to kind of start moving in a certain direction. Anyway, as I'll do a more in-depth video on this and what are the best times of day to trade, but this is really critical, right? If you're not in the right time of day, right? If you're not what ICT call these kill zones, these macros, right? Then price is way less likely to go in your favor, right? It's just not going to get respected. And so why do I spend so much time going over these two things before I even show you the entry model? Because if you do not have these things in order, my friend, you're going to lose money. Focus on understanding these parts before you even get to the entry model. Now, let's finally go over the 22 model entry model. Okay? So the 22 model entry model is very simple, right? Like I said, ICT said that if he was going to teach anything to his little daughter that doesn't know much about trading and wants to make it very easy for her to digest, right, he would teach her this strategy. So that if you are someone who hasn't been profitable yet, if you're someone who wants to make money and you just think everything is a little complicated to see, then this is a model that is really easy for you to see and it's really easy for it to repeat. Now, watch it. So first, we take out some sort of liquidity, right? So that could be, a recent low, equal highs, equal lows, etc., right? Break of market structure, fair value gap, and that's really it. That's what actually makes a 22 model. Okay, so how does that look like in practice? Let's try it out. All right. I forgot what this writing tool is. What the hell is this writing tool? Oh, there it is. All right. So what does that look like? 22 model looks like this. So you have a low right here. Go up. Go down, sweeping this liquidity right here. You see that? That liquidity gets swept, right? Any orders below here gets taken out. Price then breaks market structure right here. That's a break of market structure, right? I cannot type. That's a break of market structure. Okay, that didn't work either. That's disgusting. Break of market structure. And then there's a fair value gap in here at some point. Price returns to that fair value gap and then rises, right? Now, that's what the typical 22 model looks like, all right? So if you do not have these things occurring at any point in time, then you should not be executing because that is not a 22 model, all right? So let's go over a couple of examples so you can see what I just said. And it also works in reverse, all right? So this is a live execution that I took today, all right? So executions are on. So you can see I bought 7 micros and I shorted up here above some of the, above these relatively equal highs over here. Now, trying to see if I can get this inefficiency to show up here too. All right, so let's go over this. Actually, executions are a little distracting. Let's move that. But just to show you guys that I actually did take this trade today, and I took it on my actual, eval account. I told you guys we're going to be trying to pass a, we're going to be trying to pass a eval account from Apex Trader Funding. I'm not funded by them at all, but this is a 50K account. I took a loss last week, but now I'm up $1,000 today. So that brings my total balance to 50,584. Right. We'll go over, what are some of my, major entry and the exit techniques later. Or sorry, not that. What are some of, what are my exact risk reward and things like that when I go to the 22 model. I just want to teach you guys the actual strategy first so you can start looking at it for yourself. All right. So where do we see that before? So let's go taking out of liquidity, right? So where did I buy? I bought right here, right? So the execution's back on. Where did I buy? I bought right here. Okay, so let's look at this even further. I think it's very clear. All right, so what do we have here? This is a low, right? Look at this low. This low right here. Bring your attention to that. All right. This low is what we would call the liquidity. Remember, taking out liquidity, recent low, equal highs, equal lows, recent high, whatever. Taking out the liquidity. Right? So there's liquidity below this low. There's orders below here. We take that out. Take out a low. Then you have a break of market structure. For those of you guys who don't know what market structure is. Market structure is high, lows, higher high, higher low, higher high, higher low. Right? Then a break of market structure is when you break that. Right? So this particular higher low to this low just got broken, right? We broke that. Price now goes like this and starts going down like this, right? This is also what we call a market maker buy model into a sell model, right? These are all things that you can, research yourselves. I'll do videos on all these things, but this is fundamental knowledge. If you don't know, then you should probably go study it in a different YouTube video. But that's what I mean by market structure. So we were making higher highs, excuse me. Right? We were making, let's bring this out a little bit more. So you can see we were making lower lows, right? So this is a high, low, lower high, lower 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 low. Now, we break market structure once this particular high is taken out. That makes sense? So this high got taken out. That's a break of market structure, right? And that's how you know price is most likely to go on the it's starting to go into your direction. It's even better when you see this candle close above this high. That's even stronger algorithmic signature that price is really about to change directions, right? And so you see price breaking from here, breaking this market structure. And then what was the last thing that we needed, right? So that was break of market structure. What is fair value gap? Okay. So where can you see the fair value gap in this? Please pause it, and then if you can see it, you can restart, but just look at it for yourself, right? All right, so the fair value gap is right here, right? Right there. You see the fair value gap. There's a fair value gap right there. So you see we retrace into that fair value gap, and look how we don't even touch the consequent encroachment of the fair value gap. That's really the middle line of it, right? So we don't even touch the middle line of it. We hover over on top of this fair value gap for a while, and then we move away. That's a really strong signature as well. If price is not even willing to fill it all in, right? Fill in this inefficiency, then price is really telling you that it's going in the other direction, okay? And so this 22 model is what you see. A break of market structure, you see a fair value gap. This is a gap, right? Right here. There's another gap right here, right? There's another gap right there. You see that? And there's another gap down here as well. None of these gaps became valid, right, in the 22 model until this market structure was broken. Once we broke that, right, I would love to see price leave these open, right, and just stay in this fair value gap and go higher, right? And then what is my draw on liquidity? So we've seen that there's not an entry model here, but remember, none of these things get validated unless we're in the time of day and we have a draw on liquidity. All these relatively equal highs up here, right? There's equilibrium around this area as well, right? There's liquidities on top of this top order, on top of this top high right here. This high is the 9:30 a.m. open high, right? That's a very key high where liquidity is probably going to be there, right? And so you see price forming that 22 model formation, but what makes you be able to trust this 22 model, right? You can really trust this 22 model because you have an understanding of where price is very likely to go, and it's the proper time of day. Notice another thing as well. Around what time is this forming? Look at the bottom of the screen. What time is this forming, right? This is forming at 10:50 a.m. That's a macro, remember? That's a macro from here, right? 10:50 to 11:10 a.m. where price is likely to seek liquidity. So that's why you see price really moving. It's moving really well. Every time you're thinking about this, go and look at these different times of day and see how price moves in those times of day versus the ones that I did not highlight, especially for the macros. Look how price starts to move and expand away and start to seek the liquidity. And so once you have all these things aligned together, that is where you know that price is very likely to actually be a profitable trade for you, right? You want to see a really clean, easy to see 22 model, right? And you also want to know where's your draw on liquidity, and it has to be at the right time of day. If these things are missing, you are not going to have a profitable trade, my friend. And that is just a fact, okay? And so with that being said, in the future, I'm gonna tell, now that you guys know what the 22 model is, please subscribe to this channel if you got a lot of value from this. Press the like button if you got a lot of value from this. In the future, I'm gonna be going over exactly what are some more refined scenarios where the 22 model is less likely to work, where it's more likely to work. Where should you keep your stop loss, right? Actually, let's just do it real quick. Typically you keep your stop loss at the low, right? At the low. But then there's actually areas to refine that, right? And where's your take profit? Typically, I would like to do a 1 to 3. That's how I do my trades, right? So if you keep your stop loss here, and you aim for 1 to 3, right? You can see we hit that. Price just goes from here all the way, right? But I actually had a refined stop loss. That's why you saw I got out around here. My stop loss was actually a little lower. It was actually below here, right? And so I could have gotten out way sooner, right? And as you get more experience, you'll actually begin to appreciate that. Yeah, you want to refine your stop loss so you don't have to wait for moves to happen over 2 hours for you to catch it, right? You can just get your quick snipes and get out. But typically you keep your stop loss below. How I refine my stop loss, you probably don't know that yet. I will go over that in future videos. So for now, you should be keeping your stop loss in a very safe place where you can trust it, and that's below the low of the 22 model. Right? This is also going to be a low that's hard to take out because we just took out this and we broke market structure, right? So you can trust that this low is going to stay intact. Anyway, I could talk about this all day. There's a lot more for me to go over on the 22 model. I have refined it to almost sheer perfection, and I would love to show you guys all that I've learned in future videos. Make sure you stay subscribed and turn the notification bell on so that you know to come back to my videos to get more. But this has been an extensive lecture on the 22 model and what makes it work the most. All right, so I'll see you guys next time. Peace and love.